Okay, guys, let's go ahead and start. Start just by saying welcome. Thank you all for joining us today. I'm Mark Khuri, co-founder and CEO of SMK Capital Management. And today we're going to be diving into the commercial real estate market. What's working out there today? What challenges do we see? And really, is the best position for capital today? What real estate sectors do we find to be very favorable for passive income and long-term growth for investors? So I'm going to go ahead and share my screen now. Give me 1 second to get that going. All right. Can you all see that okay? Maybe just put another chat in the chat box. That'd be great. Okay, perfect. Thanks, guys. All right, so I'm going to go ahead and begin. We do have a Q&A box, which some of you have already started using, of course. I would urge you all to drop questions in there as they come to mind. No need to wait till the end. I will review the questions as they come through, all right? Now, we're going to cover a lot of information today. Some of you are going to want to take notes. I would also mention that we plan to get done within the hour, depending on how much questions and answers sections we have throughout the process. Now, our goal today is for you all to leave with a clear understanding of the key data and trends and really the opportunities that are shaping the market today, along with providing you some actionable insights that can support your investment decisions moving forward. So with that, let's get rolling here. A brief disclaimer, the information shared today is for educational purposes only. It's not investment advice. All investments involve risk. You should consult your attorney, advisor, or accountant to understand risks of investments prior to investing. So today's agenda, we're going to start with a brief overview about our firm. For those of you that may not be intimately familiar with SMK, we'll share a bit about our background, our investment strategy. We'll talk about today's commercial real estate market. Why now? What are some of the data and trends that we're finding compelling in today's space? From there, we'll shift gears. We'll talk a bit specifically about some of the real estate recession-resistant sectors that we believe are well positioned for passive income and long-term success. We're also going to talk about specific opportunities that we think are likely to outperform in this cycle, what we're investing in, and what we're passing on and why. And so that's the main flow for today. And we'll just start with a brief overview of our firm. We say this a lot, but we believe that who you invest with is just as, if not maybe more important than what you invest in. So a brief overview about us and our firm, SMK Capital Management. We are a family-owned private equity real estate investment company. We've been providing investors with passive income and growth opportunities since 2010. We've created over 65 individual partnerships and investments over the years with our investors, predominantly through private real estate. How did we get started? Well, my father is a retired orthopedic surgeon by trade. He's been in real estate since the 1970s. I got my start in 2005 while working in corporate America. I was a financial analyst for a number of years and started investing in real estate on the side. During the recession, my family and I started pooling our capital together, really building a small portfolio of properties in a few different states. At that time, we were heavily focused on single-family homes and smaller apartments, a lot of distressed, all cash purchases from the bank. By 2010, I was, of course, hooked, left the corporate world, formed SMK, partnering with my father. And for the next 7 years or so, our main strategy as a company was as an operating partner. We would acquire, renovate, and sell and sometimes rent a portfolio of properties that we built over the years, encompassing over 60 total properties, partnering with SMK investors. We've since divested and sold all of those. And at the same time, my family and I were diversifying our own personal holdings as well. We were making a lot of passive investments into other real estate sectors that we wanted to have exposure to, but weren't necessarily experts in operating. And that included mobile home parks, self-storage, some student housing. We've done during that time period over 20 investments in 10 different real estate sectors. And we came away from that time period with a good amount of data that we could compare and contrast different real estate strategies, different sectors, different operating partners. And so from that point forward, we essentially pivoted a bit of our strategy really to what we continue to do today, where we utilize established relationships with other investment firms, operating partners, sponsors to access private institutional quality real estate. We focus a lot on diversification across different real estate sectors and operating partners. And in 2018, we saw some indicators in the marketplace that there could be a recession soon. And so we started positioning our capital. We still do this today, really focusing on what we consider to be recession-resistant sectors. And our main strategy, we build diversified funds where we are investing in multiple properties, regions, and operating partners across the country. We also invest in specific single assets, very targeted investments as well. So funds and single assets is really what our focus is today. As far as investment criteria or performance goes, we're really looking for investments that can provide our investors with 3 to 7% cash flow starting from year one. We want that to be growing over the hold period through various value add measures, looking for an average cash flow of 7 to 12% while we hold an investment. And then when we sell, from start to finish, we're looking for average annual ROI. We like to say in the mid-teens, give or take. Here we say 13 to 20%. Equity multiple, important to us as well. That's the growth side of things, of course, really 1.5 to 2.5x. And a 2.0x means essentially you're doubling your capital over the investment term. So we screen a lot of deals. Today, it's honestly about 2 different investment opportunities every day. We're investing in 4 to 8 a year. And so it's a pretty specific process that we have where we're looking for deals that we have very high conviction on, that we believe have a high probability of meeting or beating the projected returns. That's really always our goal here. So roughly 98, 90%, 99% of the deals that we invest in today, that we don't invest in today, we only invest in about 1 or 2% of the deals that we see. So it's a pretty specific filtering process, which we'll talk a bit more about later in the slideshow. All right, here we summarize the syndicated real estate investments that we have invested in with other operating partners. These are those that have gone full cycle. You'll see our average internal rate of return has been 23%. Now, we don't underwrite to this. As I mentioned, we tend to make it a priority to just identify and allocate capital to deals that we think have conservative underwriting where we can meet or beat the projected returns. That's really always the goal here. Now let's shift gears and talk about the current investment environment. Give me 1 second. We'll go to that now. All right. Macro data and trends. We'll start with a brief update on inflation and interest rates, some of our favorite topics as of lately, right? So here we have a great chart. This is the 10-year Treasury yield. For those of you not familiar with this, it's a U.S. government bond widely used as a benchmark for long-term interest rates. Think about mortgage rates on real estate, right? It influences anything from mortgage interest rates to corporate borrowing costs. It also reflects investor expectations for inflation and economic growth. And this chart goes back to the 1960s. And what I want to highlight is that historically, we're not that high. But this space here in yellow and orange, you can see how quickly interest rates over the last couple of years have skyrocketed, and that's really caused a lot of pain and stress in this space, which we'll talk more about in a minute here. Now, a lot of you will probably recall this chart. This is CPI, or Consumer Price Index, inflation. This is post-COVID inflation. you'll see in blue just how quickly, this is really just a reminder for everybody of how quickly inflation was increasing from 2021 to 2022, when we reached over 9% in early 2022. And so what was the response? Well, the Fed came in maybe perhaps too late, but nonetheless, they raised interest rates at the fastest pace in 40 years. So this is the 10-year Treasury again from 2021 till just earlier this week. It's increased over 500% during this time period. And this has caused a lot of shock to the market, which we'll talk about in a second here. Now, going back to the CPI chart, if we open up the rest of this chart, you can see, of course, that inflation has come down significantly. We conclude, of course, that the Fed has been successful in bringing down inflation. We're still around 2.3, 2.4%. And so that essentially has worked based on where inflation stays today. Now, with inflation at a more manageable level, the Fed began cutting interest rates in 2024. However, as of lately, the last few quarters, they've paused any further cuts, largely citing, overall continued uncertainty, particularly around tariffs that could reignite inflation. And we also have a strong job market. And so the Fed has adopted more of a cautious wait and see approach before moving forward with any additional rate cuts. So I want to just open up a quick question for everybody, which you can see on the screen here. If you guys could all just take a second, answer this question for me. Do you think that the Fed will cut interest rates further in 2025? Love to hear what you guys think. And we'll let that poll sit there for a second here while we get some answers, and I'll share those with you in a moment. But the main reason why this is important, guys, is because interest rate cuts are expected to, as you can see on the screen, lower borrowing costs, improve asset valuations, and increase transactional activity. Now, together, these factors could provide a great boost to the commercial real estate market. So we don't know what's going to happen, and I'll go ahead and share these poll results with you. So 58% of respondents have said yes, they do expect or think that the Fed will cut in 2025. 25% no, and 17% unsure. So really, we're all unsure, but the Fed has signaled, and as of lately, continued to signal that there are cuts coming. So we'll see. But thank you all for taking a moment to answer that question. Okay, let's keep moving forward here. Any other questions come to mind at this point? Feel free to put them in the chat box. And we'll go ahead and answer those as they come through here. Okay, let's see. Got it. What real estate markets are you investing in? Okay. It's a great question. So, we're somewhat market agnostic. We're currently active where you have equity placed in over 30 states across the US. There are some areas that we don't invest a lot in. The Northeast is one, predominantly because you don't see a lot of cash flow. We tend to focus on, I would say, more affordable housing type assets that can produce positive income. California is tough, although we do a little bit in California, same type of concept. We tend to stay away from more expensive markets where it's hard to provide cash flow. We do love the Midwest, and we love the South, Southeast, the Carolinas, Texas, Kansas City, Michigan, etc. So those are technically where a lot of our investments land. Okay, let's keep going, guys. I don't see any other questions at the moment. So let's talk specifically now and shift gears about more real estate, commercial real estate data and trends. There's a number of data points and market trends that suggest now may be an opportune time to be investing in commercial real estate that I want to share with you. So over the past few years, maybe not everybody knows this, but the commercial real estate sector has undergone a significant reset in valuations. We've really seen what we call a historic market correction, Personally, I think it's a recession that this industry has been through, and it's creating a prime buying opportunity right now. We have seen asset prices decline anywhere from 15 to 25%, depending on location and vintage and asset type. So on average, about 20%. And we haven't seen this type of decline in pricing from the peak since, really 2008 and 9, so over 15 years ago. And as where we sit today, asset values are stabilizing. So we're starting to see a lot of signs and indicators that the worst is likely behind us and that timing is probably on our side. Now, here's a chart I want to share with you. This is from Green Street Advisors. It really helps outline the recent trend in commercial real estate pricing. You can see the average change in pricing in green. This line goes back to 1998. And this is the price across 12 real estate sectors. So it looks pretty broadly at the overall market. It includes industrial, it includes malls, and it also includes office and apartments and several other asset classes as well. But what I want to point out here is the 2008, 2009 financial crisis and recession. You can see pricing dropped, roughly 20% from where it was prior. And then pricing rebounded, continued to increase up until this point here. This is the onset of COVID and the stay-at-home orders. We saw an abrupt drop there and then quickly rebounding very rapidly in valuations up again to the point where the Fed started putting the brakes on inflation and essentially raising interest rates at a very rapid pace that we haven't seen since the early 80s. Since then, valuations have come down roughly again about 20%. Now, fast forward to mid-2024, we can see this chart where it's gone now. Okay, prices are rebounding, and we're really starting to see the potential that the bottom and the worst is behind us from a valuation decline standpoint. This again is about the time where the Fed stopped raising interest rates and started cutting as well. Now, just a reminder here, guys, markets move in cycles. A lot of the data is pointing to the idea that the US commercial real estate market is likely moved past a very, very challenging phase from 2022 to 2024. Okay, let's keep going. As of lately, the commercial real estate credit market has been experiencing a surge in available capital. This is financing, debt, right? One of the attributes that are positive in real estate is that you can borrow money in order to acquire it. And so the availability of those funds is important in order to have a healthy market. And so we've seen a lot of re-entry of debt options from banks, debt funds, and other lenders really competing for high quality deals. And so the market currently has more debt financing available than there are borrowers. Again, a great sign of a healthy market. Now, what we want to look at here is transactional volume. So you see here in 2007 to 2009, this is the number of transactions or the dollars value of transactions in the US real estate market. And it dropped significantly during this time period. And the reason predominantly, of course, there was a large recession and the economy was faltered, but also the credit markets for real estate borrowing dried up. It was very difficult back then, if not impossible, to borrow money to acquire real estate. We were buying all cash during that time. That is not the case today, although we do have a similar transactional decline, as you can see further here on the right, from 2021 to 2023, where transaction volume has dropped significantly as a result of the rising interest rate pace that the Fed enacted. But we're starting to see improvement, you can see in the green arrow. And so essentially what we're showing you here, guys, there's a lot of signals of a recovery of the market. Increased liquidity and available debt options is one. We're in a much different spot today than we were back in 2008 and 9. We've also started seeing interest rate cuts. We'll see if there's more. Now we're going to share with you some more recovery signals, including cap rates and demand. So cap rates, for those of you that may not be too familiar, we'll just give a quick overview, but essentially cap rates represent the relationship between a property's net operating income and its purchase price. And you can see the formula, it's pretty straightforward. It's calculated by dividing net operating income by the property value. So to put this into context for some of you that may not be that experienced, if you have a constant net operating income, let's just keep it the same for a property. In a rising cap rate environment, it means the price of that asset is going down. And in a declining cap rate environment, it means that the asset price is going up. So what's going on in today's market? Well, you can see where we were in 2009. It was essentially flat after a period of expansion. And then we've essentially had declining cap rates here in green all the way down to 2022, 2021-ish, right around this period, where again, the Fed put the brakes on inflation and raised interest rates, and correspondingly, cap rates have expanded. And so we mentioned here, after several years of rising cap rates, the market appears to be nearing its peak. Cap rates look to have plateaued, which you can see flatlining here. And there's some projections out there from different surveys that cap rates may actually begin to start declining in the coming year, year and a half or so. And so we'll see where this goes. But again, it looks like that the worst is likely behind us for the commercial real estate sector. Okay, let me share this chart with you. This is a great one that breaks down the pricing trends of different real estate sectors. And so we have in gray manufactured housing at the top, which is mobile home parks. Essentially, what this chart is showing us is the cumulative change in commercial property pricing for the past 7 years. And so going back to 2018 is essentially the baseline. And for the past 7 years, what we're showing here is that mobile home park valuations have peaked in 2022. They were up 80%. So number one performing from valuation growth standpoint. They've since come down roughly, 20% or so, but are starting to tick back up again. Again, right around 2024, middle of 2024 through today. And today they're still up 60% values of mobile home parks versus 7 years ago. So this chart helps us kind of look at some of the asset classes that have done well through a lot of the turbulence, right? This includes COVID, this includes inflation, it also includes rapid increase in interest rates, and you can see those that have been the most stable. So starting with mobile homes, industrial's also done quite well here in green. It's also starting to tick back up again. Self-storage still declining a bit, and there's not a lot that are still showing this kind of downward trend. And so we're currently quite cautious on self-storage. Rental rates have come down, street rates have come down. Some of that is due to a few different attributes that self-storage is essentially susceptible to. And we'll talk more about that specifically in a minute. I just want you to keep looking at this though. We've got apartments in green. Again, looks like that the values bottomed in early 2024 and have been steadily going up, somewhat flatlining as of lately. I think a lot of that is in anticipation of what's going to happen in the broader economy and, of course, interest rates. And we won't go through all of them, but if you look at the tan one at the bottom here, this is office. So office pricing or valuations have come down, 40% or so over even just the last 3 years, right? There's relatively flat from 2018 to 2022. But that asset class has just really seen a decline in demand from users and also buyers. And that's where you see a significant drop in valuation. Okay, I'm going to poll you guys one more question here. Let me pull it up. So if you guys could take a moment and answer this question, we'd love to hear from you. What real estate sectors are you all focusing on? Where do you think you should be investing, or where are you investing? And what sectors are you avoiding? Right? This is important, right? We aren't talking about all of them here. There's more, but I'd love to hear from some of you on that one as well. Now, while we wait for answers to come in, there's a question here about what class are those cap rate averages, Class B? So I think I'm going to go back to that slide. So this is more of a broad market overlook. These cap rate averages are really for the whole market. So it's not for any specific real estate class of multifamily or apartments. It's for cap rates, bond yields across the entire market. This is all property cap rate. So that should answer the question for you guys there. Okay, let's go ahead and look at some of the answers to the second question. We'll give it just another minute. I see people are still writing in there for which real estate sectors they are focusing on and which they are avoiding. One more second here, guys, and we'll read the results to you. All right. So we've got people who are focusing on apartment and office. All right, great. Mobile homes, medical, student housing. Got it. That's great. Focus on industrial, medical, avoiding retail. Okay. Focusing on residential rental. Okay. Another medical office and avoiding self-storage. Last one here, mostly in residential, but looking to diversify. Okay. Thank you all for answering that one. I appreciate it. Let's keep going into the next section. All right. So we're not pursuing certain asset classes that I'll say this. I'm going to share with you the type of sectors that we're not investing in. But it's not really because they don't offer or potentially have good projected returns similar to the investments that we are doing. The reason why we don't do a lot of these sectors is they tend to carry more risk, right? They might offer less downside protection. They might be more closely correlated to broader economic cycles. And so we tend to avoid these sectors. And the first one I'm mentioning here is development or new construction. Don't do a lot of new construction. We find it to be, high risk investment without any cash flow or income while we hold. And as of the last, I don't know, 2 years, 3 years or so, most of the returns that we see just aren't high enough for me to get comfortable with the amount of extra risk that we're going to take. Office, some of you like office. Again, it could be a great contrarian play right now. We tend to stay away because of the uncertainty of where this sector is going, right? We like to look at our exit. In 5 to 10 years, when we go to sell, are there going to be more buyers? Are there going to be less buyers? Is it going to be easy to finance? We just don't know where that's going right now. And so it tends to be outside of our risk tolerance levels. Student housing, similar to senior housing and some medical, you tend to see higher operating expenses. The cost to own and operate these real estate sectors tend to be higher than some of the others that we get into without a corresponding higher return. Doesn't mean you can't do well. We just find that there's extra risk without a substantially higher return on investment. Lodging, hotel, motel. I'd say it's a little bit of a boom bust type asset sector. You could do really great during good times and you could really do quite bad during tough times. So we tend not to get into there. It is more correlated to the overall economy, where if there's a recession, less people are going to be traveling, less people are going to be staying in a hotel, and you see revenues can be quite volatile during those time periods. Similarly, Airbnb, again, more correlated to the overall economy, less people taking vacations. Valuations tend to be correlated to residential real estate, so not necessarily looking at them as a business and how much money they produce. And so they can be correlated to residential real estate in a local market. And so while you can do well, you also can find times where the demand drops off pretty quickly. Indoor malls, I didn't see anybody mention they're investing in indoor malls, but Florida's got some that seem to be doing quite well. And especially when it's really hot, people want to go inside for air conditioning. And so there's a time and place where this could make sense. We tend to stay away from it for some of the same reasons as office. Just don't know how many buyers are going to be there in 5 to 10 years when it's time to go sell something. Now, we do focus on what we would consider to be more recession-resistant asset classes that can offer strong risk-adjusted returns. We're really looking for consistent cash flow and assets that have a lower correlation to the overall economy. We're looking again for stability across varying market cycles. So where we do focus is on triple net industrial, private real estate debt, some self-storage, mobile home parks, and some multifamily. And so I want to spend just a minute or so talking about some of the attributes of each one of these real estate sectors and why we are focusing on them and continue to focus on them. We'll start with triple net industrial or net lease industrial. We love the sale leaseback space here. This is a niche within industrial where you have a company, it's typically a manufacturing business that owns and operates their business out of the real estate that they want to sell or are selling. So what you end up having in this situation is you're buying the real estate from the owner and they become your tenant after you purchase the property. And so there's 100% occupancy after acquisition, which is a great place to be starting, of course. You also see these as more of a stable long-term asset. The lease durations, once you acquire and the owner becomes your tenant, are usually 10 to 20 years. They have renewal options. They've got annual rent increases. So it just provides a pretty predictable income stream. And you also have a great hedge against inflation. Seeing that they're triple net, it essentially means that the tenant is responsible for all the expenses. That includes property taxes, insurance, utilities, building maintenance. It all is on the tenant's burden. And so in times of inflation, expenses tend to rise. And if those are not on the owner's dime, then of course you can hedge yourself against inflationary times. In addition, you see rent escalations every year. The rent's going up anywhere from 2 to 3%. That really helps drive predictable net operating income. Now, one thing I want to mention about this sector, we've really seen a very attractive entry point. These are the cap rates in the net lease sector going back to 2014. So this blue line is essentially showing us that cap rates are at a 10-year high. So this is really historic pricing, a great time to be getting into this space. And so we find it to be a really good sector for today and the market that we're in. Let's move over. We're talking about real estate debt. We do invest in debt. And so why? Well, lower risk. You're essentially the bank. Our capital is being lent to real estate owners, a lot of times through shorter term bridge loans. And they can provide a fixed income source, right? Since we're the debt and not the equity, there's no upside. And so that's one of the downfalls to it. But there's some positives as well. And a few reasons why we like it. Debt sits senior to equity, so investors are repaid first when something is sold. And as long as you're in first position, trust deed position, you have a secured investment secured by the tangible asset. So you can always foreclose or take over the property and sell it. That really helps reduce downside risk compared to equity investments. There's also attractive liquidity options through redemption requests. And so a lot of these funds can provide you with an exit if you want to get out of the investment in a shorter duration. Sometimes there's a 1 or 2 year lockup period at which point you can then redeem and get your interest and investment back out of these deals. Target annual returns of 9 to 12% beginning in the first year. And so very attractive fixed income stream in a lower risk position. And so again, predictable cash flows are one of the main reasons we love this space right now. Self-storage, we'll talk about some of the positive attributes here. Some of you are familiar with these, of course. You tend to get longer term tenants, the lower average monthly cost for a user of self-storage. The average of a 5x10 unit in March of this year was $76 a month. And so historically, being able to raise rents consistently with the market has been essentially a lot of the strategy, although self-storage, as I mentioned, has been difficult lately, which we can talk more about in a second, but there is still a lot of demand. You have over 11% of Americans renting out a storage unit. Short-term rental rates are one of the benefits here as well. Since the contracts are month to month, you can raise rents, you can lower rents to keep retention on the tenants and the customers during difficult times and good times. And so being flexible is very helpful. Um, Historically, through multiple cycles, self-storage has done well. We got into this space in 2012. We saw how some of the REITs were doing in 2008 and 9. They were quite positive, while some of the other real estate investment trusts, publicly traded stuff, had seen some significant drops in valuations. So more recession resistant historically is one of the reasons we like this space. And it does have a low overhead business model. You tend to see lower operating expenses in order to run these facilities. They have lower inflationary aspect to it because of the fact that there's not a ton of utility bills, right? You don't have gas, electric, water, etc. at all these essentially lockers for your stuff. And so you tend to find buildings are relatively easy to maintain. You can manage 1,000 units with, 2 full-time staff, for example. So let me ask another question to you all, and we've touched a little bit on this, but what I want to bring to your attention is that everything has risk. And so the question I want to ask you all right now, here it is. What do you think some of the biggest risks in self-storage investing are? And I will leave that one open for a minute so you guys can answer. Let me know what you think there. Another minute here, guys. The answers are coming in. Thank you all for taking a moment, catching you off guard. If you don't know, that's okay. We will share some with you. Okay, let me close this one down. And if I happen to cut you off with these questions and you're still typing, feel free to put your answer into the Q&A box and we can cover that shortly as well. So, self-storage risks. Let's see what everyone's thinking on that. So, too much new product coming online, someone said. Okay, dealing with crime. All right. Competition, low barrier to entry. Unemployment, recession, defaults, operations. Okay, yeah, competition. All right, overbuilt. Yeah, good. This is great. So I'll share with you how we think about this, guys. There definitely has been some underperformance in the self-storage market for a few reasons. First, being overbuilt is one. Self-storage, one of the biggest risks is oversupply, and it's very market specific, very local specific. It's easy to build self-storage. It's one of the lowest cost real estate asset classes you can build. If you think about it, there's just not a lot to it, right? And so they go up fast, they go up cheap. The new stuff competes with the old stuff. If you're looking for self-storage in your local market, you're likely going to go online. You're going to find a place that's close to you, and you're going to compare pricing. You don't care how old or shiny or new it is, right? And so that's where you see self-storage being quite susceptible to new supply. And supply has gone up in recent years. It has caused certain markets to have an abundance of supply, be way oversupplied. For example, there's been moratoriums in certain cities and municipalities across the US where they will not allow any more self-storage to be built. That's how bad some markets have seen growth of self-storage. When that happens, it can take years for you to lease up the property, and it can affect the overall market where they're like some of the institutional groups, the REITs will come in, they'll build, and they will just offer concessions and free rent for 3 months and all types of low incentives for people to come in and lease up with them. And that can really hurt the other properties in the community. And so we've seen that. We've seen rent declines because of this. Another big risk is that we find that self-storage can be correlated to the housing market, meaning if people aren't buying and selling houses, the demand for storage tends to go down. And that has been the case as of lately. I don't know if you've read some headlines recently, but there's a bit of a stalling out in the residential home market where there's a lot of homes coming on the market for sale that are not being bought. And so the lack of transactions tends to reduce the demand for storage. When the transactional activity picks up, that increases the demand for storage. And so happy to share those thoughts with you guys. We are cautiously optimistic, I would say, that storage will be in a better place in the near term, but it has gone through some headwinds to say the least. All right, next real estate sector that we're focusing on, mobile home parks. One of our favorite asset classes, has been a big part of my portfolio since 2012 when I first started getting into it. I won't go through everything, guys, on the slide, but essentially think about it this way. The mobile home parks typically rent the land to the tenants that own their homes. Now, not all mobile home park residents own their home. They might rent the home, but they're also paying lot rent. And so you do have some communities, really nice communities in the country that have a pride of ownership. And if the tenant owns their home, they're essentially a resident, they have to take care of all the home expenses themselves. They have to pay for the maintenance and upkeep and utilities on that home. And so that results in a lower maintenance costs and low operating expense ratios for the park owner. 90% of mobile homes are never moved. Shocking stat, not a lot of people think of, but it's quite expensive and cost prohibitive oftentimes to move a mobile home, if you think 5 to 10K. So you tend to have long-term residents staying at these communities. We do have a situation in the country that many of you are aware of where we have an affordable housing crisis. This is nationwide, and mobile homes are one of the most affordable housing solutions. And so we love the idea of the demand on this side of this and also being able to provide affordable housing to many people that need it. 20 million people live in mobile homes in the US. That's approximately about 6% of US households. And we're seeing a lot of retirees downsizing, choosing to live in mobile home communities, obviously on low or fixed incomes. Limited supply, contrary to self-storage. It's very hard to build a new mobile home community in a desirable location and have it be affordable. And so what we see is the number of mobile home parks in the US is technically flat. Sometimes it goes down because a developer will come in and literally raise the entire community to build, much more dense housing, which also provides more income for the community, the county that it's in. And so you have a lot of zoning restrictions that create high barrier to entry for new developments. So limited supply, which is one of the unique characteristics of mobile homes that you don't see in a lot of other real estate sectors. Favorable tax benefits, accelerated depreciation for land improvements. You get a 15-year depreciation schedule versus more 27 and a half for residential real estate. So a lot of our investments in mobile homes provide passive losses to our investors starting in the first year. Inefficiencies. So I'll just summarize here. There's a lot of mom and pop owners that own maybe one or two communities. They may not be managing them professionally. They maybe haven't raised rents to the market rate in a decade plus. We see these kinds of opportunities all the time. And that's really where a lot of our focus is where we can come in and improve the performance, put money back into the community, improve its overall curb appeal, and also do well from an investment standpoint. Okay, let's see if there's any other questions at this point on anything we've got going on today. Okay, we already answered that. All right, let's keep going. So multifamily, I want to spend a few minutes talking about multifamily. This is the apartment sector. It's what most people are familiar with. And of course, we can say that we're providing an affordable housing option in a lot of markets where there's very high barriers to homeownership of entry. It's really hard these days for folks to afford a house, just to be transparent. And so apartment demand is going up. I'll show you a slide about that in a second. And here that is. So in Q1, we saw the highest demand for apartments in 30 years. This is the chart here from RealPage. This is the net apartment absorption, so the number of vacant units that have been rented. And so you can see that that is going up drastically. Just a sign of the times of where we are today with the high cost of living, high cost of, well, just about everything these days. And so more and more people are living in apartments. You do get compelling tax advantages. I mean, almost all of the real estate sectors provide this other than, the fixed income area, where we get depreciation and cost segregation studies that provide really attractive deductions for investors, passive losses. We can increase rents in apartments. It's not always the case, and I'll show you some slides about that in a second. But you also can bill back utilities to the tenants to improve income. There's, one of the things that's important that we look at in every real estate sector is the strong exit optionality, right? So what we mean by that is in 5, 10 years, we're very confident there's going to be a lot of buyers for apartments. It is the largest and most liquid real estate sector. You've got institutional buyers, private buyers, 1031 buyers. And so we're comfortable with that. The reality of apartments is you just don't want to be forced to sell them at the wrong time. If you can hang on long enough and operate them well, you'll likely do quite well in the long run. Additional advantages, you get some pretty favorable financing from the agencies. There's value add opportunities. You can come in and renovate the units, of course, and improve them and their curb appeal and increase the rents. Yeah, okay, let's shift over to challenges. This is important. So multifamily has had its challenges over the past few years. I want to go through some of the hurdles that we've seen in this sector, and we'll start with elevated operating expenses. You can see this chart. It basically is showing the cost of operating a multifamily community on average from these 5 years and the increase in these line items, right? These are all expenses that the property owner needs to pay. And it's property insurance is dwarfing everything else. I'll get to that one last, but you could see payrolls up 30%, for example. And that affects the bottom line. All of this affects the bottom line. Taxes are up, utilities, etc. And so this has been a damper on cash flow, free cash flow on multifamily. We've seen elevated expenses. Insurance, one of the highest here, has basically doubled over the last 5 years or so. Now, we've seen property insurance come down a bit, but it still remains elevated. And so underwriting standards today need to really take into account high operating expenses. You really want to be careful about what you think it's going to cost to operate these properties. And so this has been a challenge, to say the least, over the last 5 years. We've also seen other challenges, and we'll talk about this, a surge in supply. There's been a lot of new supply, new apartments being built across the US, predominantly in markets that were undersupplied, but a lot of it is coming online and trying to get leased up around the same time. And so what we look at here is called multifamily starts. Now, a start is defined by essentially when excavation begins on a new apartment complex that's being built. What you see here is this steep increase around 2021 through 2022 and into 2023, where new construction went up to the highest levels on record. Okay, some of this is exacerbated from 2020. COVID slowed down a lot of these projects, and then they came back online over the coming years. And so keep this in mind while I shift to the next slide, rent growth trends. So despite strong demand, rent growth has cooled off due to even more supply. And so going back, if you look at this slide, what we're trying to show you here is the year-over-year rent growth. And so when a tenant's lease comes up for renewal, oftentimes that rent will go up. Historically, from 2008 to 2020, that's around 3%, right, to keep up with inflation. But then during the lockdown era of COVID, rents dropped a bit, And once that era was lifted and the stay-at-home orders were removed, we saw just rapid expansion in rent growth. And a lot of that was due to some of the undersupply. A lot of it was due to people working remotely and moving across the country to different areas where it was more by choice where they wanted to live. It was unsustainable, right? 15% rent growth was around the peak in 2022. It's also the same time when the Fed started putting the brakes on inflation and interest rates. And also the same time when a lot of the supply started coming online. So now there's a lot of vacant buildings that need to be leased up. And so what we saw was rent growth on apartments dropped pretty drastically year over year. And here's where we are today, continuing to fast forward. We're starting to see rent growth again, which hasn't been the case. You can see the headline here again from RealPage. US apartment rent growth crawls up to 21-month high. So we're not quite out of the weeds yet, guys, but there's a lot of really interesting data here showing that perhaps the worst is behind us in the multifamily sector. Now, going back to new construction. Okay, this is the same chart from before, but look where we are now. Multifamily starts have hit a 13-year low. So what's happening here is builders have largely pressed pause on building new communities and starting new projects, really due to a lot of the market uncertainty that we talked about, potential tariffs, higher labor, higher construction costs, high borrowing costs, right? And interest rates on construction financing are high and expensive. And so what we're seeing here is that supply is now starting to abate. We're not quite through it yet, but it's a really important stat to know that the surge in supply is likely short term, and we anticipate within the coming year or so that a lot of the excess supply would have been leased up and will be in a different market at that point. One attribute here to talk about, apartments have been challenged by higher interest rates and new supply. And again, it's likely that these trends may be short term and somewhat in the rearview mirror. We're not quite through it all. But here's an interesting stat. This is rental retention. What does that mean? This is the tenants that when their lease comes up for renewal, they're choosing to stay and renew their lease. And look at the trend that you're seeing here, okay? It's increasing over the last year because there's less options out there. Definitely home ownership is out of reach for many households, and supply is starting to work through the system. So we do think that positive momentum is showing, and that multifamily is pretty well positioned for growth in the coming years. All right, guys, let's pivot here. Are there any other questions at this point that I haven't answered that I can take care of for you guys? I'll wait for those to come in. We answered that one. Okay. So let's review some of the investments that we are making, right? We are actively investing in the market. We do feel this is an opportune time to be placing capital into certain real estate sectors. And we're currently investing primarily through our fourth alternative fund, which is a diversified offering. We also sometimes do offer direct asset investments, as we noted. So we'll see if we come up with those in the next couple of months as well. But here's a first investment. We briefly touched on this sector. This is an investment we made through our fund into an industrial sale leaseback portfolio. And this portfolio currently owns 8 industrial properties in 4 states. They've got 20-year triple net leases on them. And the portfolio is growing. Our operating partners are scheduled to close on 4 more acquisitions just in this quarter in 2025. So even within this space, we're diversified across a number of properties and states. And one of the attractive attributes, and I'll tell you more about this in a minute, but the purchase cap rate of these assets has been in the high 7 to high 8% range, which is really good going in cap rate when the fixed rate debt has been at 6.2 to 6.75%. And so what we call this is a positive spread or positive leverage. One of the reasons we like these investments is we're able to see the going in cap rate higher than the cost of the debt. It really helps provide us with, positive cash flow starting in year 1 and helps reduce risk because the assets are producing a healthy amount of income. This fund is fully audited by Eisner Amper, and the targeted returns are 15% IRR, 1.8 to a 2.0 equity multiple, or MOIC, same thing, a multiple on invested capital. A 2.0 basically means you're doubling your capital over the investment term with an average cash flow of 7%. So income plus growth, one of the great investments that we love today. Now, I want to share with you a spotlight on one of the tenants in this portfolio, right? It's important to understand who you're leasing the property back to for 20 years. And our operating partners have a in-house credit analyst team, and so they dive into the financial security of the tenant before they lease, of course, and buy the property from them. So this is Robbins Flooring. They are a sports court manufacturer. They were founded in 1894. That's not a typo. And so they've been around for a very long time. They essentially build a lot of basketball courts, something none of us probably thought of. They own 35% of the market share. And their firm was bought in January of 2024 by a private equity company. Private equity company and Robbins, aren't in the real estate business. So they sell the real estate that they own, and our operating partners buy it, we invest in it, and they lease it back for 20 years. And so they can then use that capital from the sale to help grow their company further. They do source all of their wood from the US, so they are pretty well insulated from global supply chains as well. I just want to highlight, this is a 6-property portfolio. You can see the location of where these properties are: Ohio, Michigan, Wisconsin, all relatively close to one another. And again, the acquisition cap rate and the fixed rate debt, really attractive spread there. 20-year triple net lease. And for the first 5 years, the rent goes up 3% each year. Now, our operating partners here, I just want to hone in on this point about positive leverage. They're in escrow on a couple and soon to be closing on a few others. This is essentially what the portfolio will look like by the end of July or August, depending if some of these close on time. You have a cap rate here and an interest rate, and you can see the positive spread or the positive leverage that these acquisitions have. And so we're well diversified, and we're also seeing really attractive positive leverage in this portfolio. All right, another investment we recently made. This is also into our alternative fund 4. This is a private real estate debt fund, more of a fixed income investment. So our capital is in first position. It's a lower risk debt fund. Our operating partners loan money to multifamily and senior housing facilities that are looking to take out HUD financing. Now, what does that mean? I'll give you a quick idea here. So HUD is the department of the government that insures loans through the FHA, the Federal Housing Authority, which is part of HUD. And these are attractive loans. They have a 35-year term. But getting a HUD loan can be hard. It can take a long time, 9 to 12 months to get approved. So this debt fund bridges the gap and essentially loans money to real estate owners that are trying to eventually get into long-term HUD refinancing. Okay, our operating partners here are the second largest HUD lender in the country. The debt fund we're invested into has lent over $3.1 billion across 128 loans in their portfolio. And so within this debt fund, we are well diversified. They also diversify the borrower risk. You can see the different type of investment strategies. It's not just all going to construction financing, for example, so that helps reduce risk. Very low default rate of 0.2% from the borrowers in their portfolio. And as far as returns go, really attractive income expected in the range of 10 to 13%. This is also a fully audited fund as well. Let me see here. It looks like we have a question just popped up. What is the lag between a start and when apartments are online? Okay, great question. I don't know the answer to that specifically. I'm sure there's some data out there as to the lag between a start and when apartments are online. It depends on a lot of things. It depends on how large of a community you're building. It depends on how many units. It depends on if you get delays in supplies or labor or anything with the city. Construction delays happen frequently. And most of the time, we've found that construction costs more than you think and it takes longer than you think. And so, another one of the reasons we don't technically invest a lot in that space. But to answer the question, to give you an estimate, can it be anywhere from 2 to 4 years from when a start happens till they're online? Okay, let's keep going here on additional investment we're making. This is a new investment we're going to make this week through our fund. This is a 5-park mobile home portfolio in Raleigh, North Carolina market. It's an off-market acquisition, 237 total pads. It's 100% occupied, and rents are currently 26% below market. So a nice opportunity there in a stable investment. Here's attractive part of it. Our operating partners got seller financing secured at 46% loan to value at 4.5% interest rate fixed for 5 years. And so what this does is it creates a really high debt service coverage ratio, or DSCR. I don't want to get too technical, but this is an important attribute of a lot of the investments we look at. And so I just want to share with you what this means for those that may not be familiar with it. But essentially, you're taking the property's net operating income, dividing it by the debt payment. So this calculation helps show the financial health of a property. It tells us, how much cash flow the property has after paying its expenses to pay the debt. And so the higher the debt service coverage ratio, the lower the risk. It has more free cash flow. So this one has a 2.21 estimated DSCR after acquisition, rising to almost 3x by the end of year one through some of the value add measures. To put this into context, a lender requires around 1.25 debt service coverage ratio. And at 1, if you think about that, it means that the property produces only enough income to pay your debt and nothing more. And at a 2, you could essentially pay the debt twice every month with the cash flow that it produces. So really attractive high debt service coverage ratio on this acquisition. We also have positive leverage. I know I've kind of beaten that horse pretty well here, but we love to see a higher going in cap rate than the interest rate. Our operating partners have a proven track record in North Carolina. 12 mobile home parks sold, median IRR of 45%. And they are co-investing $1.45 million of personal capital into this acquisition. There's a value add strategy here, raising the rents to be in line with market and also converting a lot of the park-owned homes to tenant-owned homes over the first 3 years. So giving the tenants the option to get on a rent-to-own program so that they can eventually become the owner of their home. Okay, let's see what's next. We're maintaining affordability. This is something that we look closely at. The year 5 projected lot rents are estimated to be 75% below today's median 2-bedroom apartment rents in the market. And so very few other options out there for affordable housing in this market. This investment is targeting a 19% IRR, a little over a 2x equity multiple, and 8 to 14% cash flow. We have a number of other investments in due diligence, guys. We're screening about 2 to 3 deals every day. I want to share just quickly a few of these with you, and then I'm going to get into some deals that we're not doing, and then we can open it up further to Q&A. But this is a multi-tenant light industrial property in Phoenix, Arizona, currently occupied by 10 tenants. It's 100% occupancy. In-place rents are 30 to 50% below market. So a lot of the leases have been in place for a number of years, and they're well below market. So the strategy here is to raise rents as leases come up for renewal and also shift them from gross interest to triple net lease on renewal so the tenants are paying the expenses as well. You can see the targeted returns here of an 18% IRR over 4 years. Another interesting opportunity that we're looking at right now, this is a tax-exempt apartment community in San Jose, California. This is 288 units. It's only 10 minutes from downtown San Jose, about 20 minutes from Silicon Valley. Pretty expensive market here, guys. So this is a low-income housing tax credit property, which is essentially an affordable housing property by definition. There's a formula based on the area median income and based on where the rents are for that affordable component. And so for keeping rents low and providing affordable housing, you create a win-win where you're essentially providing affordable housing to a community that greatly needs it. And also owners are getting 100% real estate property tax exemption. So this property doesn't have to pay real estate taxes, which are very high in California. And so that's a big advantage. It's also not subject to rent control due to the affordable structure. So these are some of the unique attributes, the kinds of deals that we like to focus on. You can see the targeted returns, really attractive, 14% IRR, right around a 3x equity multiple and 6 to 11% annual cash flow. Lastly, this apartment community has been 97% occupied for the last 11 years. So really stable cash flow and growth type investment. Okay, last investment, currently due diligence. This is another mobile home portfolio. This is an off-market property, 4 properties, all within 2 hours of one another, 335 total lots in the Michigan area. The owner passed away here. This is a distressed sale. It was at probate, and the acquisition price is less than $50K a site, which according to our comp analysis is showing that it's about 34% below comps. Lot rents, 19% below market. There's also some vacant lots at these communities, and so there's a potential opportunity to infill, where you bring in new or used homes into the community and sell or lease them out, providing more affordable housing, increasing revenue and net operating income for the owners. Target returns, 20% IRR, 2x equity multiple, and a 7 to 8% annual cash flow. Okay. Now, I want to share with you investments we've passed on recently and why. This is an important part of what we do every day, analyzing risk versus return. So I'm going to go through these and share with you some of the features that we essentially made us turn and pause on making an investment. First one is 248 units in Dallas, Texas. We've also passed on 200 units in Charlotte, North Carolina. Self-storage, 472 units in Evans, Colorado. We also passed on 2 mobile home parks in Ohio. And there's been several debt and credit funds that we've looked at, and we just couldn't get comfortable with them for reasons I'll share with you in a moment here. Why we pass. So big one today is financial engineering is what we like to call it. Utilizing aggressive underwriting projections to estimate and project attractive returns for investors. What do I mean by that? Well, I have a background in finance. I've been doing this for 15 years as well. And so look at a lot of pro forma projections. And I'll tell you right now, if you give me an Excel spreadsheet showing the projections of an investment, I can change them in 5 minutes and make the returns look much higher. And so we watch out for that. That's exactly what we focus on. And so some of the things we look for and that you guys can look for, cap rate compression, assumed from the onset of the investment. So what this means is, let's assume that one of these acquisitions, I think, for example, the Dallas, Texas apartments, I believe the going in cap rate was about 5.25%. That's what they're buying it for today. And they assume that when they sell it in a few years, that they'll sell it for a 4.75% cap rate. That is an aggressive underwriting assumption. That could happen. Don't get me wrong. They might not be wrong. They could be right. But I would much rather see an exit cap of 6% built into the pro forma projections. And then if we're in a market where the cap rate is actually 4.75, great. You're going to hit it out of the park and you're going to do even better than you thought. So we watch out for cap rate compression from the exit assumption of what they're going to sell the property for. Another financial engineering strategy that we see on a lot of deals that we tend to stay away from is preferred equity ahead of common equity. What I mean by this is the capital stack, the amount of capital needed to purchase and renovate, if there's renovation dollars, the property. You have the majority is usually the debt, right? First position lender. And then a lot of times it's common equity, and that's usually where we invest. But a lot of times we're seeing preferred equity slipping in between the common and the debt. And what that is a tranche of capital from investors that is in second position behind the debt, but ahead of the common equity. So when it comes time to sell the property, you see that the lender gets paid first, and then the preferred equity holders plus their return, then the common equity. So we don't like sitting behind preferred equity. It just increases risk. It acts like more debt on the property, in our opinion. And a lot of times, the reason why operating partners put preferred equity into their deals is for two reasons. One, they have investors looking for some lower risk that can yield, 8 to 10% is common in preferred equity today. But they're not in a debt position, right? So we don't like that position because we can get those yields in a debt position. So there's still investors out there that like preferred equity. They invest in it. It also helps increase the return to the common equity. That's a big reason for it. And so if the preferred equity is capped at 8 to 10% and they don't participate in the upside above that, it leaves more cash flow for the common equity than otherwise would be available. And so it's just another way of creating a complex structure that can increase risk for common equity. And so we tend to stay away from that. Negative leverage is the opposite of positive leverage, where, of course, you have the interest rate higher than the cap rate, and the amount of leverage that they put on these deals can fluctuate. And so we watch out for negative leverage where the property isn't producing a lot of positive cash flow. And then what you'll see, which we don't like to see, is a return of capital versus a return on capital. And what I mean by that is on some of these thinner margin deals or negative leverage deals, you will see the operating partner over raising equity at the onset of the investment. And they put some of that in the bank and they just hold on to it. And they're going to return that to you in the first year or two in the form of distributions. But what's actually happening is they're returning your money to you. They're not actually providing you with cash flow from the operations of the property. And so it's a little bit of a way of hiding the fact that there isn't enough cash flow to give you a solid return in the first year or two. So we tend to stay away from those structures. We also stay away from a lot of short-term financing, which many of the deals I'm sharing with you here, especially the apartment deals, had. Think about 3-year term, the loan matures in 3 years, and then you might have the option to extend it for a year or two further. But it just adds more risk, guys, right? You are forcing the timing of this property's performance to a shorter window. So you have to do something in year 3, whether you sell or refinance or extend the loan. It creates more risk than having a little bit of a longer term, fixed type loan on this. And the potential to extend is there, but a lot of times it can come with high costs, fees, and you might also be susceptible to loan covenants regarding the debt yield or other types of performance metrics, where if the property isn't doing very well, you could be in default. And so we try and avoid those types of financing terms as well. Another thing that causes us to pause, excessive execution risk, where the return on investment is predominantly on the back end at the time of the sale. And so value add deals, great, we love them. But when they're excessively baked into the back end and don't have enough cash flow while we hold, we tend to steer away from those kinds of deals. You can find these relatively easily where you have a high projected IRR or overall return, but low cash on cash return. I mean, we've seen some like this self-storage deal that we passed on. I think it had a 2 to 3% cash flow for the first 4 years. I mean, that is not interesting to us. And so essentially, the operating partner has to do a lot of work and perform really well in order for you to get a return on the back end when the property's sold. We also see a lot of poor waterfall structures, I would say unfavorable for investors, heavily weighted to operating partners, high fees. And on high fees, we'll talk about in a second, but regarding the waterfall structure, what this is referring to is the preferred return that investors usually have to hit before there's a split of the cash flow and profits. And so many of these deals are structured with 7 or 8% preferred return that investors need to earn annually. Once the property is hitting that, any excess cash flow is split with the operating partner, usually 70-30, 70% to the investor, 30% to the operating partner. But we've seen some, I would say, heavily weighted fees that are not in line with market rates, where it's split the other way, 20% to the investor, 80% to the operating partner. So we just don't participate in that. We also see stuff, again, on, I think it was a self-storage deal here, low preferred return, 5-6%, with multiple hurdles. And what we mean by that is once that preferred return is met, there might be a 70-30 split up until a 12. Once you get a 12, then there's a 60-40 split up until a 15. Once you get to 15, there's a 50-50 split. So this really just limits the upside potential of investors, right? If the property is going to hit a home run, I want to participate in that upside. And so these are some of the structures that we tend to stay away from that we find increased risk and are less favorable for investors. High acquisition fees. We just saw in this apartment deal, 4% acquisition fee on the purchase price. I mean, that is really high, guys. You're essentially paying a ton of money up front just for the operating partner to take your money and buy the property. And so market rates are 1-2%. So be careful of those as well. Debt funds, there's a whole multitude of different debt funds out there. And so what we look for here is weak collateral that's actually in second position, promissory notes, secured by depreciating asset. Be careful of this stuff. Like there's mobile home debt funds out there where you can loan money to the community that is going to then let the tenants buy the home. But you don't know what's going to happen with the value of your collateral, right? That mobile home could depreciate over the next several years, 5 years, 10 years, whatever it might be. So we tend to stay away from those. Debt funds can be tricky. Credit funds can be tricky. It's really important to understand the type of collateral that's backing the loan and whether your investment is actually secured in first trust deed or maybe just a promissory note. And so we stay away from those as well. All right, a couple quotes I want to share with you guys before we wrap things up. This is from Warren Buffett. Don't pass up something that's attractive today because you think you'll find something better tomorrow. And then the late Charlie Munger, Warren Buffett's closest business partner, in 2022, so quite timely, he said, "I'm always just looking for something that's good enough to put Munger money in. In my whole adult life, I've never hoarded cash waiting for better conditions. I've just invested in the best thing I could find. I don't think I'm going to change now." Okay, before we close, are there any other questions that we didn't get to? Let me see here. Somebody asked, sorry, here it is. How do you select your operating partners? Okay, yeah, good question. A lot of it is through existing experience where many of our operating partners we have active capital with in the seven figures. And so we know them very well. They're actively managing properties that we're invested in together, and they bring us deal flow as it comes. And so a lot of it is relationship based. When looking into new potential operating partners, it takes time. We go slow. We have vetted and analyzed over 150 different real estate investment firms over the years as an operating partner. I'll tell you this, the vast majority we don't invest with for a lot of different reasons. The size, the experience, their track record, their communication style or lack thereof. How well do they report? Are we getting financials regularly? How accessible are they? As part of The whole process, we do a lot of asset management after we invest throughout the life of an investment. We're on monthly, quarterly asset management calls, really dissecting the performance of how our investments are doing. And so if that isn't an option and is not available, that obviously gives us a bit of a red flag with that operating partner. And then we're looking for teams that we think are, really good at what they do. Strong track record, proven performance. They're specialists in one thing that they do very well, and they're doing it over and over. So rather than try and compete, we join them. And that's really the thought process of it. So that's part of it. We could talk a lot more about how we select operating partners, but I'll just share this. Most of them have 500 million in assets under management or more, many of them billion plus in assets under management. Built out acquisitions teams, built out operations teams, a back office, finance, accounting. And so if any one, two, three, four folks happen to no longer be around, it won't affect our investments, right? That's the business continuity portion. And so I think that's a pretty good overview on our operating partners and how we select them. Another question just came in. Do you have any current opportunities available for new investors? And I assume investors need to be accredited. Okay, yes. Investors do need to be accredited for the majority of our investments. Almost everything does require accreditation. We do currently have our alternative fund 4 open for investment, which I'm happy to share more information with those of you that are interested in learning about it. And we'll see if we offer some one-off investments in the coming quarter or so as well. Any other questions, guys, that are coming to mind today? Please put them in the chat box. And I also mentioned this, if you want to have a conversation about anything we did or didn't talk about, I welcome it. You can book a call with me. My email is right on the screen. You can also use the QR code to schedule a call directly with me. I don't see any more questions at this point, guys. So I just really hope that today's session offered some valuable insight to you all into what's happening behind the scenes in the real estate sectors that we're investing in and those that we're not, and we think are really where the best place is today for income and growth. So thank you again. Appreciate everyone's time. Have a great day.